All right, fairly a good day for the markets where both the headline indices have ended at the day's high level. Rupee has also appreciated in the past three sessions, and we've seen about 1.5% gains coming in from the rupee as well against the US dollar. Apart from that, the market breadth has significantly improved. VIX has fallen. So from a levels perspective, it looks like a positive way ahead right now. But yes, it's a good start for the week, and we'll watch out how the remainder of the session looks like. But yes, let's quickly talk more about markets and, of course, how it looks like for the long term. We have with us Somnath Mukherjee, who is the CIO of Ask Private Wealth, joining us to discuss how the long term looks like. Somnath, good afternoon. So good to have you. And fairly today, markets look like quite resilient despite the kind of headlines that we're seeing from the West Asia. I mean, do you think investors are becoming more complacent about the macro risks?
Well, I don't know about investors getting more complacent, but certainly there is a certain amount of sentiment at play with all the news flow being somewhat positive overnight on the political, the ceasefire, the geopolitics around West Asia. So I think the market has reacted just to that, and it's been doing that for the last 2 months. We've seen several times whenever there's a green shoot of sorts of the conflict seemingly winding down, there is a bit of a bump up in the market. I wouldn't sort of extrapolate it too much. I don't think there's too much to be extrapolated. We've seen several such fits and starts in the journey. The good thing is that the ceasefire is still holding. The missiles are not being fired from either side, and we are not seeing those pictures. But anything more, we should hold our horses and see actual statements on the ground from real policymakers before we decide one way or the other.
Okay, got it, got it. Somnath, but now that we are seeing Brent below that $100, right now it's at about 97 against the US dollar. I
Yeah.
mean, do you think the worst of the oil price swings could be over? And what would that mean for the markets?
Yeah, I mean, as far as oil is concerned, and more importantly, from an Indian perspective, it's a straight hit to the current account deficit. A lot of the recent past pessimism on the Indian rupee has, I think, been predicated on a steady state oil price of 120, $125 for the rest of the year. Now, that was clearly a very, very worst case scenario of sorts, which wasn't terribly tenable, and a lot of the pressure on the rupee emanated from there. So again, it's a bit difficult to say whether this is the worst in the oil prices because tomorrow somebody gives a comment on the other side, or somebody tweets out something that denotes that no, the war is still ongoing or the negotiations are not close to getting over, and we might see a spike back in oil prices as well. But I think the more relevant piece for us is the dollar rupee, which has been in the news for the last week or two, all for the wrong reasons. And there, surely, rupee is at a pretty oversold position, and I think that's the more material thing that investors should be looking at instead of taking a call one way or the other again on oil prices.
Okay, got it, got it. But given the kind of recovery that we have seen today, do you think such recovery can sustain for the medium term at least?
Uh, can't say. As I said, I think this is too short and too episodic to make a very large derivation out of. There's just overnight statements, and some of those statements are sort of, Marco Rubio said in an event or a press conference. I don't quite remember that good news is on the anvil or some such. I'm paraphrasing in a few hours' time. So I think it looks like a deal is very close to getting done, but the fact is it's not done. And it's not done, as they say, till the fat lady sings. And I think till that time, I would be loath to making a longer term prediction.
Okay, got it, got it. But Somnath, most of the management commentary that we have heard so far from the March quarter performance, they have not really given out a guidance for FY27. They've refrained from saying so, or either they have indicated that the first quarter is going to be fairly weak because of the input cost inflation. In terms of estimates, what are you estimating for FY27? What are you working with right now? Before the war started,
Yeah.
what was the estimate, and of course, what is now?
No, sure. I think the reason why we have seen very sparse management commentary is that most managements probably, and for absolutely right reasons, don't know. The war really started in the last couple of weeks of the year, of the quarter rather, and since then there's been two aspects to the disruption. One, a price impact, which of course is felt in input prices and can be reasonably well modeled out. The second is just a supply disruption across a host of commodities, a whole host of specialty chemicals, a whole host of stuff. The supply chain per se has been disrupted out. So it's not just about a higher price, but it's about availability or the availability of a market at any price at all. And that is impossible nearly to model in, which is why the management commentary for the next quarter has been relatively iffy or non-committal, if I may use that word. I think we should play it by the year. That's a more meaningful exercise to do. Fact is, we don't know how long this supply chain disruption will last. How long indeed, even if the war were to end tomorrow, for example, how long it will take for the supply chains to get rebuilt up again. For example, the gas field, the world's largest gas field, which is co-shared between Qatar and Iran, that's got damaged during the war. Now, by some estimates, it might take as much as 3 or 5 years for that whole capacity to come back fully on stream. Till then, what happens to both gas availability and indeed gas prices is something that will get discovered in the next few weeks and months to come. So it's a little tough to make judgments, especially companies that are either exposed to the affected war zone in terms of markets or indeed dependent on them for critical supply inputs. The crude oil price increase, that's relatively easy to model in. There is a certain amount of inflation that we are heading into. And in general, we are heading into a higher inflationary world, I think, at a more medium term level as well. Beginning of this year, we were looking at Nifty earnings or broader market earnings growth in the late teens. I think that number will certainly get revised and revised downwards.
Okay. So, do you see any possible earnings downgrades for the next couple of quarters?
Most likely. There should be, at a broader market level, we are likely to see earnings downgrades coming in, rolling in now. Most of the sell side brokerages have refrained from actively downgrading because, as I said, it's very difficult to model something that is completely out of a model itself. If something is not available, how do you price it in any case? It's not available at any price. It's not been done, but as this war kind of winds down and we find, or the markets find a modus vivendi of sorts in terms of how to access certain types of commodities and the prices sort of truly start reflecting actual availability of that product or that input, modeling will become easier. And at that time, we'll see, and I think a very high likelihood that there will be some downgrades.
Okay, got it, got it. So, now today we've seen that all of these financial stocks have driven the rally. Be it your, private lenders, PSU stocks, all of them have done quite well and they've aided to the sentiment. But the quick question is that
Yeah.
the credit growth that has remained soft for the last 2 years. Do you think we can see sustained outperformance from here on, or was this just a temporary bounce that we have seen?
Yeah, I'm not a big fan of trying to extrapolate from a couple of days of price
Right.
movements, but is banking well positioned currently? The answer is yes. I think credit costs are at lows that we have seldom seen. By and large, the whole credit deposit, mix issue that certain larger banks, it was never a pan banking issue, but certainly some of the larger banks faced it. That seems to be getting a lot more under control. And credit growth should mimic nominal GDP growth. And there is a certain amount of capex that is expected. Some of it already in the pipeline, some of it will happen as the world adopts or adapts to a new reality of geopolitical tensions all around, which will necessitate alternative supply chains, alternative industrial capacities. All of that will mean new capacities will need to get set up. And I think that will clearly require a certain level of capex from corporates. That should have tailwinds for the banking sector. So you put all of these three things together, along with the fact that we are likely to be in a higher interest rate scenario. The next few quarters are likely to have yields higher, and banks typically tend to make money when tend to make more money when interest rates are high rather than when interest rates are low. Looks like they are well positioned. The banking system and the banking sector from an investing perspective as well.
Okay, got it. Somnath, you like banks then. Apart from banks, anywhere else where you're finding a positive growth
So
visibility?
we like inflation sensitive. So sectors that
Hmm.
are that tend to have tailwinds on account of inflation are the areas that are likely to do well. Power, the entire power ecosystem around some of the areas around emerging data centers, transmission, um, uh, things that involve materials, hard assets. So the broad thesis is that we are getting into a higher inflationary world compared to what we've seen in the last 30, 35 years, where inflation has generally been quite modest and quite low. We are looking at a higher inflation, higher interest rate world for the next couple of years at least. And in that kind of a world, we like sectors that are likely to benefit from this process towards a higher inflation scenario. And I think infrastructure, especially power and the power ecosystem, energy transition, some of the ancillary areas that are listed in India around data centers, those are the those are the themes that are likely to do well.
Hmm. Okay, got it, got it. With the kind of fuel increases that we've seen for the fourth time now in just the last 10 days, how are you positioned for the OMC stocks? Of course, we've seen a decent amount of correction, but now that the companies have started their fuel price hikes, do you think that the worst of the fall is contained from here on?
No, I think it's too early to opine one way or the other if the worst of the fall is behind us, simply because what we don't know is how far are we from an absolute sort of line drawn in the sand.
Hmm.
One on the war itself or the progress of this and a settlement of sorts, and second, how is the supply chain kind of trying to price in what is a significant disruption in the pipe itself. So I wouldn't jump to a conclusion. As I said, I'm not a great fan of extrapolating basis a couple of days of data, price data. So I wouldn't make that conclusion right now. It could be, it could
Hmm.
well be, but I think too early.
Okay, too early for the time being. All right, Somnath, lovely conversation, but with that, we have to let you go. Thank you so much for your time and, of course, connecting with us.
Thank you. Thank you.
Thank you. All right, that was Somnath for us, taking us through how the medium term trajectory looks like for the markets and, of course, the sectors that you like at the current moment. But yes, with that, we have to, wrap up the edition.